Hey everyone, Douglas here, and welcome back to the MMT Macro Trader in this market recap for Friday, January 13th, 2023. Quick word on the markets where we're at. Strong day today, or strong recovery today. We gave a lot back from the gains we saw earlier in the week as we kind of trickled lower in the overnight session, but that quickly reversed, and we've now had a few strong days in a row following the CPI data, and then some strength even following last week's data as well. I think we're turning the corner here. I think there's reason to believe. I've made my case as to why I think we could end up seeing a pretty bullish market through 2023. I've talked about it a few times during recent live streams and a few updates. So check those out if you're interested in what's kind of what I'm thinking for 2023. And I think all that still stands, even though what we're going to talk about tonight is a very serious looming threat, not only to markets, but to the global economy. And this is a threat that I think we need to get on our radar now. Probably won't be an immediate threat, probably will be something that we begin to really see come to fruition as we make our way through 2023. But it is without a doubt the biggest threat that markets, that the global economy could face, and it is what I'm hearing out of Washington, and it has to do with really a core tenet of MMT. So that's what we're going to be talking about tonight. Before I do that, though, if you are new here, make sure you hit that subscribe button and turn that notification bell on as well. And if you end up finding this video particularly helpful, give it a thumbs up on the way out. What are we talking about tonight, though? What is this looming threat? It's everything that we're hearing from Washington, particularly from the Republicans, about cutting U.S. deficit spending and reducing the national debt. During the circus that was going on a week ago, while the Republicans were trying to nominate a new House Speaker, multiple times people got up. I heard Representative French Hill from Arkansas, I believe, give a 5-minute impassioned speech on why the top priority for Republicans needs to be to cut spending, and that Kevin McCarthy was the guy to do that. Same thing from Lauren Boebert, very similar approach about cutting spending, and that it's the spending that has caused the inflation. And then finally Kevin McCarthy coming out a day or two ago, and along this entire time saying very similar things about cutting spending, and looks like that is going to be their MO for 2023, is to get government spending under control, as they would call it. And it seems like this is more than lip service. It seems like this is really the mission of the Republicans. And from my sense of where the Democrats are, I think they might go along with this. Now, obviously, from an MMT perspective, we know what government spending actually is. It is, by definition, private sector savings. And so as the government spends, the private sector gets more savings. That effectively capitalizes the private sector, and that is truly the base at which economic growth comes from. And I'm going to show some data tonight that can hopefully demonstrate that a little bit more. What I have up on the screen right now is the U.S. national debt from 1970 until October of last year, and I've adjusted it for inflation. I've overlaid the S&P as well. And I know these are obviously on different scales. We'll look at the percent change in just a second, but there's no doubt that the most volatile time that the U.S. markets have ever seen was from the dot-com bubble bursting through the great financial crisis. And of course, as you can see on the chart, that is when the national debt during the 90s took the biggest hit, never recovered enough. So again, the theory here from an MMT perspective is that as you drain the pool of money, right? So when the government stops spending and they start collecting more taxes than they send out, you're actually draining the savings of the private sector. And in reverse, you increase the savings of the private sector when the government spends more than it takes in. And at the end of the day, when you get money, when you get some sort of income, you either are going to save it or you're going to spend it. And there's a huge tax advantage to save it. And so what we end up seeing over time is a very strong correlation between not only things like growth and just the expansion of any given economy and government spending, but you'll also see in a situation where you have a tax advantage to invest in stocks, you'll see a stock market also track that. So even if you decide not to save it, it, and the person that you buy something from, you decide to spend it, the person that you buy something from, even if you choose not to save it, they might save it. Eventually, the spending, the government spending, becomes the savings of that economy. And again, because of the massive propensity to save in tax deferred vehicles, 401ks, that sort of thing, you'll see a strong correlation between stocks and between the national debt. Now, there are ways to still get growth. We'll talk about that in just a second, in terms of how we saw growth during the quote unquote growth during the 90s and what to expect there. But suffice to say that that if inflation remains high, which I'm not convinced it is, check the last live stream for that. But if inflation still remains relatively elevated and we start to get government spending being cut, that's going to be an absolute recipe for disaster, as the inflation-adjusted U.S. national debt will start to shrivel, and that just means that the capitalization of the private sector will begin to evaporate, whether that's in real terms or inflation-adjusted nominal terms or real terms. Now, in and of itself, this chart may not convince the most statistically astute of you, so we're going to dive one layer deeper and then ultimately two layers deeper to take a look at this in a slightly more dynamic way here. And so, what I want to do is I want to overlay the percent change of the national debt, so effectively the deficit, against the percent change of the year, the percent change of the returns of the S&P 500. What you end up seeing is a very strong correlation between the two. Right now, granted, correlation is not causation, but it's the first step in at least kind of proving that there actually is a causal mechanism between deficit spending and then the forward return, the return of stocks. And so I don't think, if you're not an MMT, or you're not necessarily going to expect this sort of relationship, but this sort of relationship makes complete sense from an MMT perspective. And what's even neater, what's even more neat, is if we take this one step further, and instead of just measuring just the rate of change, we measure the acceleration of the national debt, again, still in real terms, and the change of the S&P 500. All of a sudden, we see that what is actually leading the change of the S&P 500 is this acceleration function of the national debt. Now, I have a lot more to share in due time on this. Bijou and I have been putting in a lot of work, doing a lot of machine learning, deep learning. We have some really cool findings that we're about to show that I think really not only kind of prove the point here that it's really kind of deficit spending that is the dog and the S&P that is the tail, but that it really proves kind of the whole MMT theory. And so, get subscribed. You're not going to want to miss that. But I'll hold off on sharing really all the juicy details here, and at least sharing the chart that hopefully is quite striking here. And there seems to be about a 6 month to a year lag in terms of this transmission between the acceleration of essentially the rate of change of the deficit and then the S&P 500. Now, back to this point though. Obviously, we have had times in the 90s and through the early aughts where we have had expansion in the S&P, but we didn't see a ton of deficit spending. So where does that come from? Well, that comes from the other big player in the world, and that is private debt. And this is why I think that if we end up getting a fiscal crunch here, right, a stoppage, fiscal expansion, that we could be in big trouble because we simply just don't have the capacity. We are up against the private debt ceiling, and I'll show you that as I bring up the total credit to the private non-financial sector data here from the BIS, that we have kind of a terminal mass here, if you will, a maximum capacity of about 170. Maybe we can get a little bit higher depending on how things play out, but about 170% of private debt to GDP is where the U.S. Will likely stall out at if we end up relying on credit expansion for growth. And of course, that endogenous money expansion, that credit expansion for growth, comes with a lot of instability, right? This is the work of Steve Keen, of Hyman Minsky, as it creates a very unstable system where the growth looks like it's creating stability, but in reality, it's creating a high amount of instability. So we don't have the capacity to grow like we did from the 80s to the 90s to double private debt to GDP during that amount of time. And I mean, in fact, we have very little room to grow via the channel of private debt expansion. And so my guess here would be that if we do end up seeing a contraction of the national debt or of deficit spending, especially in real terms, that it would be relatively short-lived where the private debt side of things can really hold on for a while before we end up seeing kind of a repeat of 2007, 2008, especially if we end up seeing a lot of malinvestment, especially if we end up seeing a lot of that credit expansion get tied to systemically the balance sheets of banks. So that is definitely a risk. At this point, again, like I said, I don't think that what we're seeing or that what we're hearing, even if the Republicans are able to really take the steps forward to enact what it is they want, that in fact it will happen in 2023. I think likely the spending is pretty much written in stone for the remainder of this year, at least this fiscal year. But starting in September, October of next, or starting the next fiscal year, starting in October of 2023, depending on how negotiations go down and depending on how things look, and if there's kind of a real resolve from the Republicans to get this done, and if the Democrats don't step up to kind of stop them, then I think we could really start to see things peter out here. So keep it on your radar. Remember this video, a year from now, and come back to it if in fact it looks like spending is going to start to be cut here, and we're going to start seeing a drop in real terms of deficit spending, because I think that will be an absolute recipe for a disaster. But again, for now, there's a pretty bullish case for 2023. The big question after that then is, how do the politics play out this year, and what's the implication for next year? So that is the kind of looming crisis that could be out there, depending on how the politics play out during 2023. So keep that on the back burner, and don't take your eye off of it for too long. So anyway, that is what I have for tonight. Don't forget to hit subscribe and turn that notification bell on. And if you are an active trader, active investor, and you want access to all this data and analysis and more, make sure you check out the Patreon page over at patreon.com/MMT Macro Trader. There will be a link in the description below. If you're a trader, check out the premium subscription. If you're just want to be a supporter of what Bijou and I are doing, we also have a supporter tier now as well, where we drop occasional kind of blog posts and theory posts and whatnot for that tier. Anyway, patreon.com/MMT Macro Trader. That's all I got for tonight. So until next time, good trading, everyone, and we'll talk to you then. Bye-bye.